Hello and welcome back to the Tax Basics walkthrough. And so this is part two. If you haven't seen part one, probably worth a watch to go back and take a look at those. But we'll dive into the second part, and this is going to be a more detailed estimate and example of how to calculate your taxes. Here's the disclosures for you. And so before we dive into that though, we're first going to look at the comparison between deductions versus the credits. And so with deductions, those reduce your taxable income. And so since your taxable income is applied at a percentage, that's not going to be nearly as valuable as receiving a credit. So the credits are a dollar for dollar tax reduction. And you may even find that some credits may be refundable depending on the credit. So just for this example, we're looking at the same equivalent. So $1,000 deduction. So primarily applies if you are talking about itemized deductions, and so maybe you could get an itemized deduction for $1,000 or a credit for $1,000. They are not the same thing as far as the impact on your taxes. So we're going to use the same kind of example of $118,000 for income for each of these scenarios, but the additional $1,000 deduction just reduces that tax to, or the taxable income to $117,000. And so since this person falls in the 22% bracket, again, one of the numbers that you would have seen on the previous video, but I'll also share with you in the next one, this person falls in the 22% income tax bracket. So that's why it reduces their taxes by $220. Looking at the credit side, $1,000 credit actually reduces your taxes by $1,000. So credits are better. It's not necessarily that you can pick and choose. You typically deal with how things fall, but if in your head you were thinking that a deduction was just as good as a credit, still helpful, not equal, not the same. And so this kind of gives you a good idea of how those two different impacts occur. So kind of a popular deduction that will reduce your taxable income, or anything that you put into a traditional 401k, that's going to reduce your income. I'm sharing with you the max contribution limits. And then as well as if you don't have a 401k, or maybe you weren't able to put a bunch away per paycheck into your 401k, but now you want to put some into your IRA account, definitely make sure that you're not phased out due to your income. But if you're not, you may be able to contribute into an IRA account and reduce your taxes for the 2018 year or so, because you actually have till the April 15th deadline to fund the IRA and the HSA accounts. And you can see HSA, that stands for a health savings account. So it's health related expenses that you'll be using these funds for once you pull them out. But those are the contribution limits, and that will also reduce your deduction for the income. Again, here's the brackets. We looked at them in the first video, but in the example that we were looking at previously, we saw that with that income that we were looking at, they fell in this 22% married filing jointly income tax bracket. So that's why of $1,000 deduction, they were reducing their taxable amount by $220 once you apply that 22%. So that's how that calculation works there. Let's look at a detailed example. So this is a couple married filing jointly. Joint income is $150,000. They have some adjustments. So student loan interest is going to help reduce some of that down by $2,000, and then HSA contributions will reduce it down by $6,000, because that's how much they paid in student loans, and that's how much they ended up contributing to their health savings account. So that gives them an adjusted gross income of $142,000. And so with that adjusted gross income, it carries over. We're gonna look now at the deduction. They looked at their itemized deductions. It wasn't going to be better than the standard deduction, so they took the $24,000, which is the standard deduction for married filing jointly. If you happen to be an individual, it is $12,000. So just for your reference, not a part of this example. This reduces their taxable income even further to $118,000. And if you remember from the previous example, the tax bracket they fell into was 22%, but that's only 22% on additional funds. The US is a progressive tax system, so you actually didn't pay 22% of the $118,000, because the lower amounts that fall in the lower brackets paid a lower amount. So the taxes owed is $17,838, and so that's still not the final deal though. They qualified for a $2,000 child credit, so that reduces that tax directly by that $2,000. and they've also paid into the federal taxes over the course of their earnings for 2018. So they paid $21,000, and so ultimately, when they look at their taxes owed, they subtract the $2,000 credit and the $21,000 paid. They're actually going to get a refund of $5,162. So hopefully that example was helpful for you. And obviously, your numbers are going to be a little bit different. Your deductions, your credits, what you've had withheld from your paycheck may look a little bit different, but that's how you can go about calculating your taxes. And so before we finish up, we're going to take a look at the 2017 tax reform. It actually has a more official name, but 2017 tax reform makes the most sense because that's when it happened, and we don't need to go into all the technical wording. But looking at the four major changes, and there's definitely additional changes that were impacted as well. Again, I just want to focus on what's going to apply to probably about 75–80% of the people that are watching this video. So previously, 2017, the standard deduction was $6,350 and $12,700 for married filing jointly. You can see that it's almost doubled in 2018, and then moving forward, it'll be adjusted for inflation. Looking at exemptions, though, that's really something that was a shock because that was removed altogether. Back 2017, it was $4,050 per exemption, and now it no longer exists. So that's one of the reasons why the standard deduction jumped up so high. Another great benefit of the changes was the child credit phase out. So in the previous example, we saw that $2,000 tax credit for the child credit. That actually gets phased out, and back in 2017, those phase out limits were extremely low. Now it's almost quadrupled or tripled in the single filing state situation, but in a married filing jointly, it's almost $400,000. So a lot of people that were not able to get that child credit in the past are actually surprised when they get it in 2018 taxes. Lastly, this may impact a lot of people if you pay a lot of property taxes or live in a state where you're paying a high state income tax. SALT deductions, that stands for state and local tax. That used to be one of the reasons why a lot of people itemize their deductions. That is capped. So back in 2017, it wasn't capped. Starting now, 2018 and moving forward, capped at $10,000. And the odd thing about that is it's capped. That's the same amount whether you're single or married filing jointly. A lot of times these things double for married filing jointly, like in the case of the standard deduction, but not in this case for the SALT deductions. It's $10,000 if you're single or $10,000 if you're married filing jointly. So that's almost like a penalty essentially for those that are married and would have preferred to not have that capped or at least have that cap up at $20,000. So we covered a lot. Hopefully that's helpful. Feel free to reach out if you have any specific questions or need guidance on this. I actually do not do taxes, but through my training to become a certified financial planner, I was required to go through this, and I always review my client's tax situation and help them through those things. So feel free to reach out, and if I don't know the answer, I definitely know a handful of awesome CPAs that I can refer you to. So take care and enjoy the last few weeks of tax season.